This is Dr. K. Jagannayaki, Professor in MBA Department, Institute of Aeronautical Engineering, Hyderabad. So today's topic, I would like to discuss few case studies on Introduction to Financial Accounting and Financial Analysis. After going through this topic, the learner will be able to understand and apply the accounting concepts in real life scenarios. So, case study 1, preparing financial statements for ABC company. So, let us go with the background of this particular case. ABC company is a small business that has just completed its first year of operations. The following information is available: cash $50,000, accounts receivable $30,000, inventory $20,000, prepaid expenses $5,000, property, plant and equipment 1 lakh, accounts payable 25,000, accrued expenses 10,000, loan payable 60,000, common stock 50,000, and retained earnings to be calculated. So the tasks to be performed are: prepare the balance sheet for ABC company at the end of its first year. Second, calculate the company's net income for the year, assuming that retained earnings at the beginning of the year were $0 and no dividends were paid. And third one, explain the importance of the balance sheet in understanding the financial position of the company. So let us analyze the case. Balance sheet preparation. So balance sheet for ABC company as of the year end. So balance sheet consists of assets and liabilities. So coming to the assets, we have current assets and non-current assets. So current assets, based on the available data, we have cash $50,000, accounts receivable 30,000, that is also current asset, inventory 20,000, prepaid expenses 5,000. So total current assets 1,05,000. The next, non-current assets. So we have only one that comes under non-current asset: property, plant and equipment 1 lakh. So total assets, just by adding total current assets plus total non-current assets, we'll get total assets $2,05,000. Then coming to liabilities and equity. Again, liabilities can be divided into two types: current liabilities and non-current liabilities. So current liabilities, under this we have accounts payable 25,000, accrued expenses 10,000, and total current liabilities 35,000. Whereas non-current liabilities, we have only loan payable. Then find out total liabilities by adding current liabilities plus non-current liabilities. We'll get $95,000 is the total liabilities. Then coming to equity, we have common stock with 50,000 and retained earnings that should be computed by taking into consideration total assets minus total liabilities minus common stock. Then whatever we will get, that is total equity. So total liability plus total equity, that is 2,05,000. Then coming to net income calculations, net income is equal to ending retained earnings minus beginning retained earnings. Since beginning retained earnings are $0 and no dividends were paid, so net income becomes $60,000. And third one is importance of the balance sheet. The balance sheet provides a snapshot of the company's financial position at a specific point of time. So it shows what the company owns, means assets, and what it owes, liabilities, and the shareholders' equity. So this information is crucial for stakeholders to assess the company's financial health, liquidity, and long-term viability. And second case study, revenue recognition for XYZ services. XYZ services provide us consulting services to various clients. The company signed a $120,000 contract with a client to provide consulting services over 12 months. The contract states that the client will pay $10,000 monthly. XYZ Services recognizes revenue based on the percentage of completion method. So, task to be performed. How should XYZ Services recognize revenue each month under the percentage of completion method? And second one, what journal entries should be made each month to record the revenue and cash received? Third one, discuss the impact of recognizing revenue using the percentage of completion method after on the financial statements. So first, revenue recognition. So under percentage of completion method, XYZ services should recognize revenue proportionally as the services are provided. Since the contract is evenly spread over 12 months, each month XYZ services will recognize $10,000 as revenue. Coming to the journal entries, at the beginning of each month, debit accounts receivable $10,000, credit revenue $10,000. When payment is received, debit cash $10,000 and credit accounts receivables $10,000. Next, impact on financial statements. So recognizing revenue using the percentage of completion method, it ensures that the financial statement reflect actual progress of the project. So this method provides a more accurate picture of the company's performance and financial health, especially for long-term contracts. It also smooths out revenue recognition, preventing large fluctuations in income. And third one, inventory valuation for LMN retailers. So background is that LMN retailers uses FIFO method, first in, first out method for inventory valuation. The following information is available. Beginning inventory 200 units at the rate of $10 each. Purchases 100 units at the rate of $12 each. 150 units at the rate of $15 each. And sales 300 units sold at $25 each. So calculate the cost of goods sold using the FIFO method. Second one, determine the ending inventory value using the FIFO method. Third, explain how the choice of inventory valuation method impacts financial statements during periods of rising prices. So, cost of goods sold under FIFO, first in, first out, the earliest inventory costs are assigned to cost of goods sold. So, cost of goods sold just by inserting the given values, and we can find out it is $3,200. Ending inventory, the remaining inventory consists of the most recent purchases. So ending inventory becomes 50 units at the rate of $15. So it is $750. And coming to impact of inventory valuation method. So FIFO, first in first out method. In periods of rising prices, FIFO result in lower COGS and higher ending inventory and leading to higher profits and taxes. Whereas if you are going for LIFO, last in first out, so this would result in higher COGS and lower ending inventory, leading to lower profits and taxes. So the choice between FIFO and LIFO affects profitability, tax liability, and the valuation of inventory on the balance sheet. Next, case study 4, depreciation methods for DEF Limited. So background, DEF Limited purchased machinery for $120,000 on January 1st, 2021. The machinery has an estimated useful life of 10 years and a residual value of $20,000. The company is considering using either the straight line method or the double declining balance method for depreciation. So coming to the task, calculate the annual depreciation expense using the straight line method. Second one, calculate the depreciation expense for the first 2 years using the double declining balance method. And third one, discuss the impact of choosing different depreciation methods on the company's financial statements. So first of all, find out depreciation expense using straight line method. So the formula is depreciation expense is equal to cost minus residual value divided by useful life. So $10,000 per year is the depreciation expense. Then apply double declining balance method. So for year 1, depreciation is equal to 2 divided by useful life into book value at the beginning of year. The same way we have to calculate for year 2 depreciation. So year 1 the depreciation value is $24,000, whereas for year 2 $19,200. Then coming to the impact on financial statements, the straight line method results in a consistent depreciation expense each year, making it easier to compare financial performance across periods. So the double declining balance method results in higher depreciation expense in the earlier years, reducing taxable income and net income initially, which could be advantageous for tax purposes. However, it also reduces the book value of assets more quickly, which can affect ratios such as return on assets. In case study 5, accounting for bad debts at GHI Corporation. So background, GHI Corporation, a company that sells products on credit, estimates that 5% of its accounts receivable will be uncollectible. At the end of the year, the company has $2 lakhs in account receivable and $5,000 credit balance in the allowed for doubtful accounts. So the tasks are calculate the bad debt expense for the year. Second, prepare the journal entry to record the bad debt expense. Third, discuss the importance of the allowance method for accounting for bad debts. So first, let us calculate bad debt expense. So here required allowance is 5% on $2 lakhs. So you'll get $10,000 and existing allowance we have $5,000. So bad debt expenses can be computed by using the formula required allowance minus existing allowance. So the bad debt expenses, the difference between these two, that is $5,000. Coming to journal entry, debit bad debt expense as it is an expense, nominal account, it should be debited $5,000 and credit allowance for doubtful accounts, the same $5,000. Then coming to the importance of the allowance method. The allowance method provides a more accurate representation of the company's financial position by recognizing potential losses from uncollectible accounts before they occur. It matches bad debt expense to the period in which the related sales were made, adhering to the matching principle in accounting. So this method also ensures that accounts receivable balance on the balance sheet reflects the net realizable value. Then case study 6, lease accounting for JKL Enterprises. JKL Enterprises entered into a 5-year lease agreement for office space starting January 1st, 2022. The annual lease payment is $30,000 payable at the beginning of each year. The lease is classified as an operating lease under previous accounting standards, but as a finance lease under the new accounting standards ASC 842 by IFRS 16. The interest rate implicit in the lease is 5%. So the tasks are calculate the lease liability and the right use of asset at the beginning of the lease term under the new accounting standards. And second, prepare journal entries for the first year of the lease under the new accounting standards. And third one, explain the difference between operating and financial leases under the new accounting standards. So first, calculate lease liability and right of use asset. So present value of lease payments we used to calculate by taking into consideration cash inflow multiplied with present value annuity factor for 5 years at 5%. So PV annuity factor 5 years at the rate of 5% is 4.3295. So lease liability is $1,29,885. Then right of use asset is equal to lease liability at the start, that is $1,29,885. Then coming to the journal entries at lease commencement, that is Jan 1st, 2022, debit right of use asset 1,29,885. Credit lease liability, as lease is a liability, so it should be credited the same amount 1,29,885. And next, debit lease liability 30,000 for the payment made, credit cash 30,000, and for the second year end 2022, amortization and interest, debit interest expense that should be calculated $4,494.25, and credit lease liability $4,494.25, and debit amortization expense, that is $25,997, and credit right of use asset same amount $25,977. Then coming to the difference between operating and finance leases. Under the new standards, finance leases require recognizing both a lease liability and a right of use asset on the balance sheet, with interest and amortization expenses recorded separately in the income statement. Whereas coming to operating leases, under the old standards, were not recognized on the balance sheet and lease payments were simply recorded as rent expense. But whereas under the new standards, operating leases are also recognized on the balance sheet, but lease expense is typically recognized on a straight line basis over the lease term. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.